Every financial crisis feels different when you are inside it. Different headlines, different excuses, different villains. But underneath the surface, the pattern never changes. First comes confidence, then comes leverage, then comes denial. And finally, when trust collapses faster than institutions can react, people return to the same place they always do: gold. Not because it is fashionable, not because it promises riches, but because when systems fail, gold does not. This video is not about price charts or predictions. It is about why gold keeps reappearing throughout history, even after being dismissed as outdated, useless, or irrelevant. To understand why gold always returns, we must first understand what gold actually represents. Most people misunderstand gold because they view it like other assets. They ask, what is the return? Does it pay income? Does it outperform stocks? These are the wrong questions. Gold does not behave like an investment. It behaves like a mirror of trust. When confidence in money is high, gold falls out of favor. When confidence weakens, gold quietly rises. Gold responds to monetary debasement, financial repression, political instability, loss of institutional credibility. Gold does not grow with productivity. It reacts to belief. Belief in currency, belief in banks, belief in governments. When belief is strong, gold looks unnecessary. When belief cracks, gold becomes essential. This is not opinion. This is behavioral finance repeated over centuries. Gold did not become valuable by decree. It became valuable because it solved a human problem. Across ancient civilizations, people needed something that could not be created easily, could not be destroyed easily, was recognized universally, required effort to obtain. Gold fit all four. Long before paper money existed, gold functioned as a store of value, a unit of account, a medium of exchange, not because it was perfect, but because it was reliable. Empires rose and fell, currencies came and went, gold remained. This historical memory matters. Even today, when no currency is backed by gold, human psychology still remembers one thing: gold outlasts systems. For much of modern history, gold acted as a constraint. Under the gold standard, governments could not print freely, debt had limits, currency expansion required reserves. This imposed discipline. Economic growth still occurred, innovation still thrived, but promises were anchored to reality. That changed in the 20th century. 2 world wars, massive debt, and political pressure made discipline inconvenient. Gold became an obstacle. In August 1971, the United States made a decision that reshaped the global financial system. The dollar was no longer redeemable for gold. Officially, this was temporary. In reality, it was permanent. From that moment, money became trust-based, debt became expandable, inflation became structural. Currencies were no longer claims on value. They became promises. Gold did not change. Money did. The 1970s revealed the consequences: high inflation, currency weakness, economic instability. Gold rose dramatically, not because it was manipulated or hyped, but because people were adjusting to a new reality. Money could be created without limit. Gold became the measuring stick of that loss. During stable growth, gold feels pointless. It does not generate income. It does not compound. It does not benefit from innovation. So people abandon it. Capital flows toward stocks, property, credit, leverage. This is always framed as progress. Gold is labeled old-fashioned, unproductive, fear-driven. This dismissal is not accidental. It happens near the peak of confidence. Gold disappears when trust is abundant. That is exactly when it is most misunderstood. The 2008 financial crisis was not just a market event. It was a psychological shock. People believed banks were safe, risk was diversified, experts were in control. All of that collapsed. At first, everything sold off, including gold, but then something shifted. Governments chose bailouts. Central banks chose liquidity. Debt was transferred, not removed. Gold recovered faster than trust. Why? Because people realized something fundamental. If losses are socialized and money is created to prevent collapse, currency value becomes uncertain. Gold rose steadily, not explosively. It reflected understanding, not panic. Modern wealth is built on systems. Stocks depend on exchanges. Bonds depend on repayment. Property depends on law and enforcement. Gold depends on none of these. It carries no counterparty risk, no default risk, no reliance on policy. This does not make gold superior. It makes it independent. That independence is precisely why it becomes relevant during crisis. Gold does not need permission to exist. Publicly, gold is dismissed. Privately, it is accumulated. Central banks still hold thousands of tons of gold. Why? Because gold is neutral, liquid, politically unaligned. It functions outside any single currency system. This is not nostalgia, it is risk management. When institutions lose faith in each other, gold becomes collateral of last resort. Gold is often portrayed as a panic asset. That framing is wrong. Gold is a hedge against certainty. It exists to remind us that models fail, systems overshoot, confidence blinds judgment. Gold does not protect against progress, it protects against arrogance. Every crisis begins with the belief that it cannot happen again. Gold exists because history disagrees. Gold returns because human behavior does not evolve at the same pace as systems. We repeat the same cycle: optimism, leverage, denial, intervention. Each time, confidence breaks. Gold does not predict crises. It reflects broken trust. It returns when people realize stability was assumed, not guaranteed. Gold is not a path to wealth. It is insurance against forgetting history. You do not hold gold because disaster is certain. You hold gold because cycles are. Gold always returns. Not because the world ends, but because trust always gets tested, and it always will.